Hi, and welcome. You're listening to the X22 Report. My name is Dave, and this is episode 1466A, and today's date is January 8th, 2018, and the title of the episode is The Economy is in the Process of Being Reworked for the Transition. Let's get into the economic collapse financial news. Now, we are headed into a point in time where it is going to get a lot worse. Now, I know a lot of people think that the economy is doing great, and I think the majority of the people in America right now, and maybe globally, they do think the economy of the world is doing a lot better, especially here in the United States. People do believe this. They feel like everything is okay, and this is a very scary moment when people do believe that things are okay like this, because this is when the central banks they pull the carpet out from under everything. And think about 2006, 2007. I mean, go back on YouTube and listen to these individuals on the corporate media and people taking out equity line of credit, and they were spending money like there was no tomorrow. And I know there's a lot of money in real estate. Remember, this is paper money. It doesn't exist yet until you sell your home or you take an equity line of credit out on your house, but you didn't make anything there. You're just borrowed against what you've earned. Now, if your house price goes down while you'll have this equity line of credit, there's major problems. This is what happened in 2008. A lot of people have done that also. And what the central bank wants is they want people to take out these additional loans on their real estate. Remember what they've done? They've pumped the real estate market up in 20 different cities. They've done as much as they possibly can. There's no more that they can do at this point. This is why you see articles coming out saying there's trillions locked up in real estate, because they want those people to take equity lines of credit out on their homes, and they want you to spend it in retail. What do they get out of this? Well, they get everyone spending in retail, hopefully to boost GDP, because 70% of GDP is retail. They also get more debt. Think about this for a second. And this is why they're coming out with those type of articles. But if you're smart, and this is my personal opinion, I wouldn't do that. I wouldn't go out and take a loan out on your paper earnings that really don't exist yet, because you didn't sell your house. Now, we are seeing that a lot of retailers, they're closing down shop. Corporations are laying off people. GoPro, they're laying off about 250 people. Of course, they're saying they're going to be reworking their entire business. They're going to be restructuring. A lot of companies say this, and they use this excuse to explain away why they're letting all these people go. I mean, if you really remember Circuit City? Well, they were restructuring also. They don't exist anymore. We know that Regis, this is Regis Corp, and they have these smart style salons inside Walmart. They're closing about 600 of these because they're underperforming, and they're restructuring. Now, once again, this means there's not a lot of people going to these places. There's 600 of them that are closing. Now, what's been happening here is that people are feeling good. Now, we've been following the economy, and we know that things are going south in the economy. We've been looking at the indicators. We've been looking at what's really been going on. And a lot of this, what we're seeing right now, duplicates what we've been seeing back prior to 2008 and prior to pretty much every recession we've seen, especially 2008. We've seen this before. Now, what we're seeing right now is that a lot of people went out and they charged their retail purchases this holiday season. A lot more than they've ever done before. And we have confirmation of this. Where we're seeing that, and this is coming from the Fed data, total consumer debt rose by $28 billion, or the most since November 1st, to $3.827 trillion, an annualized increase of 8.8%, or roughly 4 times faster than the pace of GDP growth. You break this down, consumer credit rose by $11.2 billion in revolving credit, or credit card debt, which pushed it a record $1.023 trillion, the highest credit card amount outstanding on record. This was also the second highest monthly increase in credit card debt on record. Now, when we look at this, we can see that the debt level has reached the point of where we were right before everything fell apart in 2008. People back then felt incredible. They felt like the economy could never implode, that real estate would never implode, that everything would be fine. And what happened? Everything fell apart. We see non-revolving credit, that's auto, student loans, that rose by 16.8 trillion to 2.805 trillion. And what we're seeing right now is that student loans has rose to 1.142 trillion. Personal savings right now has dropped by 2.9%. This is the lowest since November of 2007. It's the same thing happening once again. People don't have savings rate. They don't have their savings. So they're using credit cards. They feel everything is going to be great because they've been told it's going to be great. And they've been using their credit cards to make purchases. While they're increasing their debt, their savings is declining. This is a disaster waiting to happen. Now, we've been discussing retail stores. We've been discussing malls. And there's a new report out there that sheds some light on all of this. This is from Green Street Advisors. They're a property research firm. They analyzed about 950 mall locations over 2017. And what they've been finding is that, well, the retail market is a lot worse than we thought. Now, out of the 950 mall locations, 230 are collateralized within commercial mortgage-backed securities. Sound kind of similar to the subprime security problem? Well, that's really what is happening here. Now, what we're seeing here is that these CMBS loans, well, they've been packaged, and right now, this is a major problem. Now, to put the mall economic model into perspective, Green Street points out that while massive department store closures tend to dominate headlines, they represent a very small portion of mall income. The real financial losses for mall owners comes via the ancillary traffic impact on national and regional tenants, which pay of the majority of mall lease income. Inline tenants, therefore, have an outsized impact on mall NOI, and their performance offers a preferred indicator of mall health. With shorter lease terms and higher rent burden, many tenants right now are making decisions in real time within each mall. The best inline tenants to track are the 300 national tenants who have at least 50 mall locations nationwide and are constantly judging the performance and cost of occupying space with any given mall. Now, Green Street says the far more pressing issue for mall investors is to analyze which stores are quietly shrinking their mall footprints organically by simply choosing to forego lease renewals. Now, roughly 70% of the 950 malls studied experienced a decrease in national retailer inline tenants. Second, while the average amount of net closures increased materially at lower quality malls, there was a wide dispersion of net closures impacting malls across the quality spectrum. Third, while half of the top 25 net closing retailers have publicly announced store closures, there's something else happening behind the scenes. These are called the quiet closing of stores. And this is the part where the corporate media is not reporting on. All those stores, those chains that are shrinking their footprint quietly. They're not making big announcements. The corporate media is not out there making big announcements. And what we're seeing is Claire's is doing this. Rue 21 is doing this. We know that Subway is doing this. Hallmark is doing this. Stride Rite is doing this. Baker's is doing this. Kenneth Cole is doing this. The Body Shop, Papaya, and many, many others are all doing this. That tells you that we have major problems ahead of us. And out of the 950, we have 230 which were collateralized within commercial-backed mortgage securities, and they're sold off, and investors get it. And we know once these stores start to default inside of these securities, we have major, major problems. Now, let's throw on top of that the pension problem. So what do we have here? Let's back up for 1 second here. We have stores that are closing that we know of. The corporate media is out there telling us. We've delved into it, and we see that there's a lot more stores closing. And of course, the corporate media is saying, yes, these stores are closing, but it's all going to online. We know that's not true. So we see that we have debt coming due for most of these retailers. We have these quiet closings that are going on behind the scenes. There's a lot of space being opened up in malls. They depend on the smaller stores within these malls, not the department stores. But if the department stores do close down, guess what? Traffic then dries up, and those people within the mall structure, those people start closing down. We also know those malls with movie theaters, well, they have less traffic. The movie production companies are putting out less movies, and less people are going to the movie theater. So we have major, major problems ahead of us. And then we have the pension problem. This brewing pension problem, well, it's been well documented. We talked about it before. We know that a lot of these pensions, they assumed a 7.6% rate of return on its assets in the future. And in order for pensions to meet this 7.6% rate of return, they require that stocks, and to a much lesser degree, alternatives, do far better than even the optimistic assumption, because the balance of the portfolio is nearly guaranteed to fall short of that mark. Now, the trouble is that we don't have 7.6% rate of return here. We don't have 8%. We have what? 1%, 1.75%, maybe 2%. So they're way off there. So they're investing in stocks. Maybe some of these mall securities, which they rated AAA. And the trouble with the stock market, they need to return anywhere near 8%. They would need to fall, the stocks would need to fall more than 50% first. And in order for the S&P 500 to be priced for an 8% expected long-term annual return, the index would presently need to trade at roughly 1281, which we know it's not. It's trading almost double that. So right now, there's a major problem. So if the stock market crashes for investors so they can have that opportunity to invest at a level that would enable them to achieve anything close to what pensions now require, well, that would destroy the pensions. But if the rates don't go up and the stock market stays where it is, they're screwed anyhow. So no matter what happens here, the pension crisis is still a problem. You can't solve it at this point, and people are going to lose out, and it's going to be a complete disaster. And on top of that, we have the global debt. It has hit a new record of $233 trillion. Now, if we go back in time to 2016, we understand that the global debt hit a new all-time high of $217 trillion. And this is coming from the Institute of International Finance, the IIF. This was 327% of global GDP. It was up $50 trillion over the past decade. Let's fast forward to today. As of January 4th, 2018, which was about 4 days ago, the IIF released its new numbers. And now we see global debt is at $233 trillion at the end of the third quarter of 2017. Now we know that it's even higher than that. And we see that we are in big trouble. The global debt is continually being pushed up. It's not slowing down. Things aren't getting better. And it's getting worse. Now there's $63 trillion in government debt, they're saying, $58 trillion in financial, $68 trillion in non-financial, and $44 trillion in household sectors. A total increase of $16 trillion increase in just 9 months. And this tells you that as the debt continually pushes upward, it can't be sustained. Because if you look around the world, a lot of people are out of work. There's austerity in countries. People have no savings. People have a lot of debt. And according to the IIF, private non-financial sector debt hit an all-time high in Canada, France, Hong Kong, South Korea, Switzerland, and Turkey. Now, we understand that this entire economy has been built on an illusion. This is why we've been looking at each part of the economic sectors to make sure that we understand what is really going on here. If we went back in time and we did this prior to 2008, we would have said, okay, the subprime securities, they are garbage. There's no way they're rated AAA. And of course, people would argue back then and say, well, they are rated AAA because S&P, Moody's, and the rest said they are. And we would have to say, no, we proved it. Look inside. They are not AAA. We would have said, hey, look, something's wrong with the housing market. Something doesn't make sense here. A lot of speculators out there, and it looks like this is one gigantic bubble. Again, people would look at this and say, no, that's not right. Housing is fine. Housing can't go down. And they would use all the same arguments that they're using today. And back then, in 2006, 2007, people thought things were fantastic. They were spending like crazy. Well, here we are once again. But this time, it's a lot worse because nothing's been fixed. Actually, what you can see they've been doing is they've taken the problem of 2008 and they just extended it with the same exact illusion. They didn't change anything. The stock market's going up just like it did prior to 2008. Back then, it only hit 14,000 points. Who cares? Today, it hit 25,000. Prior to that, what did it hit? 10,000? Prior to that, what did it hit? 8,000? Back in the 70s, when we went into a recession, it hit an all-time high of 1,000. It makes no difference. That's not the economy. And what is happening here is that we, in this country, the Trump administration, is prepping the economy for the transition. And we can see this right now. Now, the corporate tax cut that he did was to bring back all that currency that is out in Europe, out of the banks, and bring it back to the country here. Is this going to fix the problem? No. And I think part of this is to break the system, to break and bring down the system, because everyone knows, yes, everyone knows, the central banks know, Trump knows, the Democrats know, the Republicans know, they all know this system can't stay up. They know the real numbers. They're in government. Yes, they might pretend that everything's great because they're getting all the free money from the central bank and a lot of them are paid off, corrupt, and blah, blah, blah. But what we're seeing here is there's a reason for all of this. Now, the tax cuts to corporations is going to bring all that money out of the banks in Europe and bring it back to the United States. That will help the United States for a little bit longer. Now, what will it do to the banks in Europe? Most likely bring them down. Where will the crash begin? Most likely in that area. The United States will probably be last. This was a temporary solution to give the United States a little bit more time, because what country is the reserve currency of the world? The United States. And this is exactly what is happening here. Now, we need to understand that Trump wants to push this infrastructure bill. Now, how is this infrastructure bill going to work? Well, we know that China is looking at West Virginia. We know that Maryland is looking at building a maglev type of train between Baltimore and Washington, which has a $5 billion commitment from Japan. And we know that Japan is looking to join the One Belt, One Road system. We know there's a lot of countries where, remember, the One Belt, One Road is driven by rail, yes, still sea. And we see that in order for all this to work, the United States will need to join the One Belt, One Road. This is why Trump has been talking about trade. And trade is going to be with China. This is why he's been meeting with Xi Jinping. They've been talking about this. This has been happening behind the scenes. Because the only way to transition out of this entire system that's imploding, and they want it to implode, this is why all this is happening right now, because a new system is being created. Now again, yes, the central bank still has a hold on this, and they know that this system can't survive. Trump has already gotten the word that the United States is no longer going to be the reserve currency of the world. It's already out in China and Russia. That's said and done. Unless the people can speak up and say, we don't want a central bank right now. But unless that's done, this is what's happening. And we can see right now that the central bank has been setting up shop. We've been reporting on this, how everything's moving from the west and the east. And in order for the United States to survive and to be operational is to bring back the money to the United States, to bring back corporations to the United States, to join the One Belt, One Road, to make deals and have China and the rest of the countries come in here and help with the infrastructure. Our infrastructure is falling apart. We're not keeping up with the rest of the world because guess what's been happening over the many, many years? All those dollars have been sent everywhere else for what? War. So we're in this transition phase of getting prepared for this reset of this entire system. That is what is happening right now. This is why you see the petro yuan. This is why you see the gold trade system. This is why Russia and China have the payment system. This is why they duplicated everything out in the East. This is why they've been purchasing gold. They might not use the gold as a gold for a gold-backed currency, but what does gold do? It restores confidence. It restores confidence in the system. Countries look at this and say, okay, you can back all of this? Yes, we can. We have the gold. The United States can't say that. Russia and China combined can back the system. I'm not saying they're going to be backing the entire currency with gold. It will restore confidence. This is the name of the game. This is what the central bankers want. They want confidence restored. Now, of course, they need a distraction. They need something to show that they're not responsible for everything that's happening here. And this is what they've been trying to do, because once the people get wind that this is the same exact system, well, the people are going to speak out. This is what the central banks don't want to happen. So this is what we've been seeing here over the many years since the even before 2008. But it's been accelerated after 2008 because they realized right now how bad the situation is, how it was accelerating. They can't stop it, and they need to make this transition soon. So they've been putting everything into place, and we can see right now that there's a fight going on between different factions within the government with the central bank, and it's not something where you can snap your finger and just have it done. If you ever worked in a corporation and you were in middle management or you're in upper management and you still had someone above that, and there were other people around you saying no, you know how hard it is to get things done. The same thing is happening in government right now. But things are changing. But we're still going through a transition. Things are going to be very messy. It's not going to be clean, a snap of a finger, everything's going to be great. Coming on to a system where it was backed by by oil back in the 70s, coming off the gold system, well, we were coming off a stable system, going on to a brand new system with very, very low debt. And look what happened there. People couldn't find jobs. There was high inflation. People like that because they were printing a lot of currency at that time. So they got the high interest rates. They were able to earn a lot on their currency in CDs and things like that. But people couldn't get fuel. Credit was kind of frozen at that time. Jobs were very hard to come by. It was kind of a mess in the 70s, but then it did improve in the 80s, and this is how their system usually works. Then the 90s, and then all of a sudden it starts breaking down into 2000, and as we approach where we are today, it gets even worse. Now we're coming off the system. We're not backed by gold. We're backed by debt. And we can see that we're losing our grip in the Middle East. So we're seeing the back side of this, and the back side of this is not going to be pleasant, especially when everything is moved away from the United States and moved someplace else. Remember, when we were coming onto the system, the United States was the reserve currency backed by gold, and it was still the reserve currency backed by oil. Now, the United States is no longer going to be the reserve currency. It's going to be shifted away from the United States, and this is going to have a ripple effect within the United States, and it's going to be very, very difficult for people. And this is why I've been saying, get ready, get prepared. Listen, everyone, thanks a lot for listening. Be well, be safe, and especially be prepared. Thanks a lot.